Today, we've invited Steve Rick to talk to us about what he sees happening with the economy, given this unusual COVID-influenced time, which has been, frankly, challenging to predict. Steve is the chief economist for CUNA Mutual Group, and Steve's forecasts provide business leaders with a clear understanding of the general economic conditions as a starting point for strategic planning. Steve was previously the senior economist for CUNA's Economics and Statistics Department for 22 years. And in addition to his work at CUNA Mutual Group, Steve serves as the chairman of the board of directors for the University of Wisconsin Credit Union. Steve's also a lecturer with the UW Economics Department, where he teaches banking and macroeconomics. Please join me in welcoming Steve.
Thank you. All right, good afternoon, everybody. Good afternoon. Let's try that one more time. Good afternoon, everybody. Good afternoon. All right. First of all, I'd like to thank the Alliance for inviting me here to speak with you all. And I just got to say, I am really glad to be here, mainly because I just found out that this next hour will count towards my community service. So I got that going for me. Well, basically, let's jump in and take a look at this economy and where we may be headed for the next 1, 2, even 3, 4 years out, kind of a long-term view. And basically, just to summarize my presentation, I'm going to borrow a phrase from a very famous author. I'm sure you've all heard of Charles Dickens. Charles Dickens wrote that very famous book, A Tale of Two Cities. What was the most famous line from that book? There it is. It was the best of times. It was the worst of times. That one phrase applies to the U.S. economy in two different ways that we will see that it's the best of times and it's the worst of times. We'll take a look at that. We'll also try to answer some big questions. Are we going into a recession next year? A lot of economists are debating that. Some say yes, some say no. We'll take a look at that. What's happening with inflation? Is inflation ever going to come down from its current level of around 8%? Will it go back to its normal 2%? And when? What's going to happen with the labor market? Are we going to be able to find workers at a relatively low price instead of getting 5, 6, 7% raises just to retain them? We'll take a look at all of these questions for the next about 3 to 5 years. So let me jump over here. Let me grab my little clicker, and we'll basically jump in and try to answer that first question. Are we going to have a recession? So we're not going to bury the lead here. Here's my first chart. You know, I'm an economist, so we have to have charts and graphs. I kind of follow the economist credo that if you can't say it with a chart or a graph, then it's probably not worth saying. So our first one here deals with the U.S. economy and its growth. Notice the green bar is going all the way back to the year 2000. What percent growth is our economy? The green bars say things are going well. The red bars are recessions. Notice those red bars. The economy is receding. In a recession, we're producing less goods and services. Notice that big bar for 2021, 5.7%. That was a booming year last year, 5.7% growth in the production of goods and services compared to 2020. There's your COVID pandemic recession, where the economy actually contracted 3.5%, producing less goods and services. What are we forecasting for this year in 2022? Notice only 1% growth. It's weak growth. Now, why do I say it's weak? We see my gold line on the chart. My gold line is what the economy wants to grow at. It's natural, it's organic growth rate. The U.S. economy wants to grow at 2% just naturally. Let me use a little analogy for you. Think of your human body. What is your normal body temperature? 98.6, right? 98.6. That's where your body wants to be. This morning at around 4 a.m., your body reaches its lowest temperature according to circadian rhythms. And by 4 p.m., in another hour or two, your body will be at its highest point. So your body cycles through lows and highs, 4 a.m. to 4 p.m. Well, the U.S. economy also cycles like that also. But think of my gold line as the 98.6 degrees. Your body wants to be there in its long run equilibrium, and the economy wants to be at 2% growth. We're only going to hit 1% this year. Next year, also a weak year. So if you want to use the word recession, call it a growth recession. We're growing below my gold line. We're not growing as fast as we normally should be, that 2% growth. So a little bit weak. Why? What's weighing on the economy? where we have a lot of uncertainty in the world because of the war in the Ukraine, that's slowing down European growth. Germany and France will go into recession this year because of energy prices up over 10 times their normal level of energy prices. That's causing a recession. As you know, we export a lot to Europe. Think of, say, Harley Davidson motorcycle up there in Milwaukee. They export a lot to the rest of the world. We export a lot of stuff, farm products, whatever, but they're going into recession. They're going to be buying less of our exports. That's going to weigh on our growth. Rising interest rates because of the Federal Reserve. We'll talk more about the Federal Reserve, but that's slowing the housing market down. Residential construction is slowing. It will slow down also commercial construction. Basically, we're trying to slow the economy down a little bit. So I got those two bars there. We have a growth recession. We could have a full-blown recession. Next year, some economists saying for next year, we could see 2023 have a red bar, a full-blown recession. But basically, let me put up my takeaways from this. Notice my first three bullet points. There's three different scenarios that economists are talking about right now. Number one is the soft landing. That's where the Federal Reserve would like to see the economy grow at 2% this year. We don't think it's going to happen. We only have about a 20% probability on that. My second point is that growth recession I just talked about. We're giving that a 50% probability. That scenario next year where the economy is growing, but relatively weak, almost like a recession. And then a full-blown recession for next year, it could happen. We're giving that a 30% probability. But if it is a recession, it's not going to be like the Great Recession we saw, say, 14, 15 years ago when the housing market crashed back in 2008, 2009. It'll be a more modest recession. Point number 4 on my list, inventories. As you know, a lot of businesses right now are still short of inventories. Just to give you an example, think of the auto industry. If you walked into a new car dealership today, let's say you went to the new Cadillac dealership here in town. If you walked into their car lot today, they only have about, say, 25 cars on the lot for sale. Compared to 2019, before COVID, they had 100 cars for sale. We're down 75% in inventory, especially in the automobile sector. Why? Why aren't there many cars on the parking lot of an average new car dealer? Yeah, semiconductor computer chip shortage. You know, we had to bring all the semiconductor computer chips from Taiwan and South Korea, but there's problems, you know, getting them over here by boat, and then they go to the port of Los Angeles or the port of Long Beach. But because of COVID, there was longshoremen who were out sick or quarantined with COVID, so they weren't unloading the ships fast enough. And even when they were unloaded, there was not enough truck drivers to drive them up to Detroit. So we have a supply chain disruption problem taking place. But that is being worked out now. GM and other auto manufacturers are almost back to normal in their production. But it's going to take them a while to rebuild the stock of inventory at, say, your average Cadillac dealership, to get it from 25 cars today up to back to 100. I'm just using those numbers to give you perspective that we're down 75% in some industries with respect to the inventories. Some good news, though, if we do have that recession next year, we have a lot of infrastructure spending in the pipeline that'll help offset, say, what's happening in the housing market. As you know, right now, mortgage interest rates are way up. I'm sure you all heard that on the news, which is slowing down the housing market. And you may say, well, that's not good. Aren't we going to lay off a lot of carpenters, electricians, plumbers, people who are building those homes? Well, no, we'll just transition them from the residential housing market into building infrastructure, roads, bridges, highways, ports, the electrical grid. So it kind of came at a nice time to have this infrastructure, over $1 trillion in infrastructure spending that'll take place out to the year 2026, which will keep these bars somewhat elevated, somewhat pushed up toward that 2% goal line where we should be, a little bit to help offset what we're seeing in some other sectors of the economy. So there's our forecast. I got people all the time coming up to me and say, hey, Mr. Economist, how good are your economic forecasts? Do you even know what the heck you're doing? And I usually respond by saying, come on, Mom, quit asking me that. But basically, that's my forecast. I'm kind of sticking to it, but we'll see what actually plays out. Now, some of you in the audience may say, wait a minute. I've heard on the news that we've had 2 consecutive quarters of negative growth. If you look on my chart, you see those 2 bars there to the right? That's the first quarter and the second quarter of this year, 2022, and they are negative. You can say, wait a minute, we've already been in a recession, haven't we? We're producing less stuff. The answer is no. Just having negative growth does not mean you're in a recession. It is a necessary condition, but it's not a sufficient condition for a full-blown recession. You also have to have job losses. We're not seeing job losses. Last month, we had over 263,000 jobs out of the economy. You have to have retail sales falling. You have to have personal income falling. None of those are happening. And notice those bars are negative for the first 2 quarters of this year, following that bar in the 4th quarter of 2021. So what explains what's going on? Remember, think of 2%. If I had a goal line in here, 2% is where we should be. Notice in the 4th quarter, we're at 6.89. What happened? One word explains that. Inventories again. Notice I've added this blue bar next to it. That blue bar shows what the inventory contribution to the growth in the economy. Think of it this way. In the 4th quarter of last year, Target, Walmart, other retailers really added to their stock of inventory. Let's just use simple numbers. Let's say they added 100 units of inventory at, say, Target. That was in the 4th quarter of last year. So think of all the factories were producing a lot of stuff to give Target their 100 units. But in the 1st quarter and 2nd quarter of this year, they were still adding to their inventory, but only, say, 50 units in the 1st quarter. And then the 2nd quarter, maybe only 30 units. So they're still adding, but at a slower pace. That will slow the economy down. And that basically, notice in the 2nd quarter, that blue bar, most of the decline in the economy was due to the fact that we're still adding inventories, but instead of about 100 units, down to 50, down to 20. So it's just declining. So basically, it was an inventory correction is what we're seeing take place in the economy today. We believe in the third quarter number, we should see pretty decent economic growth. We should come bouncing back. Let's move on. The big question on the minds of most economists and most Americans when it comes to economics is what? What's the big question we're all facing today? Inflation. Let me put that inflation question into a poem form. Here's the poem. Inflation or deflation? Tell me if you can. Will we be Zimbabwe or will we be Japan? Basically, Zimbabwe is a country in Africa. About 12 years ago, they had over 1 billion% inflation. Now, I did not misspeak. It was 1 billion% inflation. Japan is on the other end of the spectrum. They've had 0% inflation for the last 30 years. Hopefully, America will fall somewhere between Japan and Zimbabwe. What does the data actually show? Here it is. Notice that blue line, 8.2% inflation is what we're currently operating under year over year. So when you take that shopping basket and you're pushing it through the grocery store, you get your receipt from the cashier. That receipt is probably 8% more than it was a year ago. If you bought, say, the same items that you bought 1 year ago, 8% more. Where should we be? According to the Consumer Price Index, the CPI, where's my gold line? Economists should always have gold lines on the chart. That's where the economy wants to be. Think of that 98.6 degree body temperature. My gold line is about 2.5. When you use the CPI, 2.5 is your goal. We're at 8.2%. It is way too high. And look how fast that line just exploded. But why? Why did inflation just explode? This is the fastest inflation in 40 years. Remember I said Charles Dickens, it's the best of times, the worst of times? This is the worst of time chart. Looking at the audience here, basically, the last 40 years, none of us were probably working 40 years ago in our careers. This is the highest inflation any of us have ever dealt with. What exploded it? Well, when you think about inflation, you can really summarize it into one phrase. It's just too many dollars chasing too few goods. Think about the too many dollars part of that. Remember, the government sent out stimulus checks, 3 of them during 2020 and 2021, to a tune of about $3,200 to most Americans. They just got this free money in the mail. $3,200 put in their checking account. They used that money to spend on goods. They went out and bought a lot of things. Remember, the other part of my inflation is on too few goods. Well, we had the supply chain disruption. So you had all these money chasing too few goods, and prices went up to this 8.2%. Notice we have turned the corner a little bit. Hopefully, we'll keep heading down from here, but it's still way too high for the Federal Reserve. Federal Reserve will be meeting next Tuesday and Wednesday. On November 2nd, which is next Wednesday, the Federal Reserve will be looking at these same charts we're looking at today. They'll be looking at them in Washington, D.C. The Federal Reserve meets every 6 weeks. They look at these same charts. They're going to look at them and say, the economy's still kind of a little bit running hot. Labor market's still tight, inflation's too high. They'll probably raise interest rates again next Wednesday, November 2nd. They'll probably raise it by 3/4 of a percentage point or 75 basis points. They are going to keep raising interest rates because of this chart right here. And when Jerome Powell, who's chairman of the Federal Reserve, when he goes to bed at night, he has one thing embroidered on his pillow: keep inflation at 2%. That is their #1 goal, and it's running too hot today. A couple other things. If you exclude, you can say, wait a minute, isn't the war in the Ukraine pushing up energy prices and food prices? Well, we can factor that out here. You see the little kind of greenish line I've added, about 6.6%? This is what we call core inflation. If you exclude that volatile food and energy sectors, the underlying price pressures, it's still around 6.6%. So yeah, we do have energy problems. We do have food problems pushing it up. You know, like grain not being exported from Ukraine and all that stuff. But basically, inflation's still too high. The Federal Reserve has to raise interest rates to bring that down. What's happening with medical care? You know, a topic really close to our hearts today. You see what I've circled at the bottom? I have here a big sheet on the Consumer Price Index. Notice medical care prices. I have the one column there, the month-over-month growth rate. Just in the last month, this is for August, prices went up 1% just in that 1 month. Let's annualize that or multiply by 12 because it's 12 months in a year. That would be a 12% increase in medical care costs. The column to the far right, the Y over Y, that's year over year prices are up 6.5%. So we are seeing medical care prices going up very quickly right now. What started with goods prices, you know, stuff you can buy and put in a bag and put in the back of your car and drive home with, those prices took off first. Now it's more service prices that are rising very quickly that have to do with labor. Because of the tight labor market, wages are rising very quickly, and it's being passed on to places that have a lot of workers. And the medical care sector is really exploding right now, like that 1%. You can see there's no other, for the month-over-month column, there's only one other service that has prices going up this fast. What's that? What is it? See that electricity service right in the middle on the month-over-month column, 1.5% there. Everything else, medical care, outpaced every other industry except for electricity. So it's moving up quite rapidly because of the long-term increase in wage costs. We'll talk more about that in a minute. Now, the one thing the Federal Reserve is going to talk a lot about next Tuesday and Wednesday at their FOMC meeting in Washington, D.C., is if inflation expectations are starting to rise. That people think, you know what, we're going to have this high inflation for a long time. They do not want that to happen. They do not want inflation expectations to get embedded into American psychology. Fortunately, it hasn't yet. And how do I know that? You see this new goal line I've added, about 2.5% on that. Basically, that is what the bond market, think of Wall Street, think of all the big hedge funds and investment banks on Wall Street. Their collective wisdom is saying we're going to have an inflation of only 2.5% each year for the next 10 years. 2.5%. So they don't believe we're locked into this new high inflation environment. They believe inflation will come down. It's going to be high for the next couple of years, but then start to go back and we use this expression in economics called reversion to the mean. That it will come back down to the mean in the long run. In the short run, we're going to be elevated, and we'll see a chart giving a forecast on that. But right now, the bond market is only expecting about 2.5% inflation each year for the next 10 years, which is good. We call this having anchored inflation expectations. Just like an anchor keeps your boat from moving in the lake, right now inflation expectations are kind of being anchored. What's the anchor? Fed credibility. Wall Street believes, Jerome Powell, that they will do whatever is necessary to get inflation back down to 2%, 2.5%. They'll keep raising interest rates and they'll keep them high enough to slow the economy enough. So we still have what we call anchored inflation. Moving on, we have this big debate amongst economists. I go to all these conferences around the country and I debate other economists about, are we going to have high inflation, low inflation, what's taking place? And I've just listed here all of the factors that are pushing up inflation. Number one was that pent up demand for goods and services because of COVID. You and me probably didn't go out and travel during COVID, or we didn't go to Yellowstone in 2020, 2021 because of the pandemic. But now we're traveling again and we're spending again. We had those $3,200 stimulus checks mailed out to us. We're spending those. That kept the economy moving. Number two, supply chain disruptions, reducing inventories. We talked about that. rising energy, commodity prices. The war in the Ukraine is intensifying that. And I've got these other factors here: massive monetary, fiscal stimulus. Fiscal stimulus, as those 3 stimulus checks mailed out. Monetary policy was really low interest rates the last few years. So if you didn't get a stimulus check, you could go out and borrow the money from your local bank or credit union at very, very low interest rates, which also increased the money supply. All right, so here's all the factors pushing it up. You can see I got number 6 there: rising housing and medical care costs. Was once again talking about medical issues here. But I have on the other side of the debate, like I said, if you have a debate, you got to have the other side. And the other side of the debate is this: what are the factors pushing inflation down? Number 1 on my list, e-commerce, one of the most powerful deflationary forces we've ever seen in the history of the world. Think of it this way: it's really hard for a local retailer on State Street to raise their price of what they're selling without losing market share to, say, Amazon or some other online company. That is keeping a lid on prices. Number 2, rising competition from globalization. Let's use Harley-Davidson again. It's really hard for a Harley-Davidson motorcycle to raise the price of their motorcycles without losing market share to Honda motorcycles, BMW motorcycles. Globalization keeps prices low. And I've got some other factors here. So notice I got 6 factors push inflation up, 6 factors trying to push it back down again. What's our overall long-term forecast? Well, here it is. Once again, economists should have those gold lines on the chart. That's my 98.6 degree body temperature, if you will. This year, 2022, look at that bar. We'll probably see 8% inflation this year. The Charles Dickens economy, the worst of times. Fortunately, we're forecasting it to slow. So prices will still be growing, but at only 4% next year. It will start to come down. Our supply chain problems are getting worked out. A lot of Americans right now are spending those stimulus checks. Like I was mentioned, I'm the chairman of the board of the University of Wisconsin Credit Union. So every month I would sit down with the CEO and at the board meetings, and we look at what's happening with deposit balances at UW Credit Union. In this summer, we saw them starting to drop, which rarely happens. In the world of banking, deposit balances always grow because you get more members and people just add more money. But they actually started to decline. So they're actually pulling money out of their checking accounts, savings accounts, and we're going out and traveling, spending, buying those airline tickets, which are very expensive today, buying hotel rooms, restaurant meals, all that service spending. So it is being spent now, and we expect that to slow down going forward. Then notice by the year 2024, the bars hit the gold line. So we use this analogy called a soft landing. That's an airplane. Think of an airplane landing on a tarmac. You've all been on planes, you've all landed on tarmac. You always want to have a soft landing, right? You don't want to hit that tarmac too hard. Notice how my bars go from 8%, 4%, down to 2.5. That's what the Fed wants to see, a nice soft landing on my gold tarmac. Get the economy right where it should be. We don't want a hard landing. That'd be like the plane hitting the tarmac too hard. That'd be like hitting a full-blown recession. Then you actually see the bars go below my goal line there. You don't want that. You don't want to have a hard landing. This is what the Fed is hoping will happen. So they're raising rates enough to reduce demand. Because how does it work? I mean, when you think of the logic of that, the Fed raises interest rates. Banks and credit unions raise their interest rates. Mortgage rates are already up. We'll talk about that in a minute. We're also seeing banks raise their rates on auto loans and car loans. That'll stop people from buying as much. And that's how it works. That's how monetary policy works. Raise interest rates so people borrow less money and hence spend less money. Get the economy down to 2.5% growth. So 2024 should be a nice year where things are more in balance. Right now, we're not in balance. We have a disequilibrium. Moving on, what are the takeaways from this? Well, one, we're seeing an increase in household financial stress. Low income people are having a hard time paying for their groceries, their heat, their rents, their gasoline. So they have to decide, do I heat or do I eat? And so they're having some financial stress there, which is pushing up some loan delinquency rates. Talking to a lot of banks, credit unions around the country, their delinquency rates are starting to rise amongst their low income customers. Number 3, whenever you see high inflation, what does this mean? Interest rates go up. The Fed will always respond. You push inflation up, interest rates will go up to counteract that. Number 4, labor costs. For most businesses, labor costs make up what? 50 to 60% of your total operating expenses. Labor costs are rising quite rapidly right now. I was just at a conference down in Dallas, Texas, giving a speech to a lot of bankers and credit unions down there. There's about 400 CEOs in the audience. We had one of those electronic voting where they could take their phones and actually vote while I was giving a speech. And the question I asked them was this: what are you going to give for a raise to your average employee this spring? You know, most of us give raises in March, whatever. I asked, what's your average going to be? What do you think the 53% out of those 400 CEOs, what do you think they told me as the average raise? 6 to 7%. They were giving a 6 to 7% raise to their employees. 22% said they're going to be above 7% because of the tight labor conditions. In order to retain the workers or to recruit new workers, they're having to pay big. Now, what we're worried about as economists is that, wait a minute, if you're paying 6, 7%, you raise your wages, you're going to have to raise the price of what you sell. And then you get what's called a wage price spiral. Wages go up, you got to raise your price. Wages go up the next year, prices go up the next year. So we're worried about a wage price spiral. We actually saw this back in the 1970s. We were in a wage price spiral. It just kept going up and up and up. Hopefully we won't see that this time. Hopefully we can say, you know, this is just a short-term phenomenon. You know, these last couple of years, 2021, 2022, 2023, and it'll come back down. We don't want to get, once again, locked in people's psychology. We're going to have high inflation, so workers keep demanding 6, 7% raises. But it is going to be high next year. We're going to see big raises take place throughout the economy just to adjust for past inflation. All right, moving on to the best of times. Remember I said this is a Charles Dickens economy. The best of times, the worst of times. Here's the best of times. It has to do with the labor market. From the point of view of the working class, basically, where's the unemployment rate at right now? 3.5%. I say that is very low. Why can I say it low? Notice my gold line again. Once again, economists should always have gold lines on the chart. That's where the economy wants to be, the natural unemployment rate, the organic. 4.5% is what economists believe. That's when the market's in balance. We're at 3.5% today, so we got a gap there. Think of that little white gap between the blue and the gold. We basically have a labor shortage today. Wages are rising. So we're concerned about that. We're concerned about this 5-6% wage increase here. What's taking place in Wisconsin? Let's narrow our focus to Wisconsin here. Basically, unemployment rate, notice it's 3.1% today. This is as of August. Notice what it was in February 2020, the month before COVID really gripped the economy. Notice in February 2020, it was at 3%. Notice how we're almost back to exactly where we were 2.5 years ago. I mean, that's the beauty of the economy. The economy is really like the human body. Your body wants to be at one temperature. Maybe you caught a cold. We got shocked away from the notice. We went all the way up to close to about 14%. But then when the body comes right back down, it heals itself. The thing about economics, it is self-equilibrating. We'll come back to where we were. We get shocked. We get hit by these, these external shocks called the COVID pandemic. But we came right back to where we were at 3.1. But it's even a tighter labor market here in Wisconsin than as a nation as a whole. Remember, nation as a whole, 3.5%. We're at 3.1% here. Very difficult to find workers. Just to show you a picture of the number of job openings in this country. You hear in the news all the time. There's around 11 million job openings today. You know, places that need workers, Harley-Davidson say needing welders, your place of employment. You can see the blue line up there, 11 million. And notice how it has just shot up in the last couple of years. Normally we'd be around 7 million. It's at 11 million today. Just to show how tight the labor market is, we have 11 million job openings. Look at the red line. That's the number of people who quit their job. What, 4.5 million? This is every month. Every month in the United States, about 4.5 million people quit their job. Why? Well, they find a better job that pays 10, 20% more. So the number of people quitting, the red line, is at the highest we've ever seen. People are switching jobs because they know there's so many jobs out there. They can switch and get 20% more. And then the green line is just how many people we hire every month in this country. About 6 million right now we're at. So just saying 6 million people just got hired last month. We have about 150 million people working in this country. 6 million get hired every month. Kind of shows you the churn that takes place in our economy. People getting hired and quitting and hired and quitting. Just to move on to look at it in a slightly different perspective, you see the green line now. This is the job openings rate. This is what I find actually more informative. Let's say you're working at a business that would normally have 100 people working there. To be fully staffed up, let's just say it's 100 people. The job openings rate, you can see today is around 7%. That means that this company that needs 100 people working, they've only got 93 people working. They have 7 open cubicles, say, that they're trying to recruit for. Notice that is the highest job openings rate in American history. So we have a lot of empty cubicles or a lot of factory floors where people aren't working. Huge gap there. And notice the red line again, the quit rate. I always find this interesting because 3% of all employees quit every month. So once again, go back to my firm that had 100 people working there. 3 people will quit this month. Next month, 3 more people will quit. Month after that, 3 more people will quit. Just think, that is a huge churn in our society. All these people quitting, and these are voluntary quits. These are not people being laid off. People say, I'm quitting because I find a better job elsewhere. Very high quit rate today because of the tight labor market. Moving on to what's taking place in the healthcare system. Healthcare is even worse. Notice the red line in my chart, just to compare it. I got my 7% overall economy, but in the healthcare industry, it's close to 9% job openings. So if a hospital is supposed to have 100 people to be fully staffed, they only have 91, 9 open positions. Just think what's happening with wages. Remember we saw earlier medical care costs going up because of the wages rising, because they have a labor shortage take place that's worse than the national average, which is my green line. Once again, medical care is the red line on this chart. So a huge labor shortage in nursing, technicians, doctors. I was just talking with Doug Benzine earlier, but he's talking about where are they finding the doctors for these new clinics out there when they've got a 9% job openings rate. I mean, look where it was back in the teens, in 13, 14, 15. It's around 3%. It's 9% today. Just think of the wages you have to pay to recruit and retain workers when you have a 9% job opening. Very, very tight labor shortage taking place in the medical care industry today. Just to kind of show you how things are kind of flipped upside down today. Notice my blue line, that's the job openings we saw earlier, 11 million, that's the blue line, 11 million jobs that we need to be filled. Notice the red line is the number of unemployed people. Just to show you how things are kind of out of whack right now, the blue is around 11 million, that's the number of labor demand that we need out there, 11 million workers. What's the labor supply? How many unemployed people are there? The red line shows where we're at today, about 6 million. So basically we have 2 job openings for every unemployed worker. We've never seen that before. So I just kind of put my little gold bars that say we have about a 5 million imbalance. Labor demand is up here at 11 million. Labor supply is down here at 6 million. In economics, we don't like things like that. We want things to be imbalanced. So we have to either bring down labor demand. How are we doing that? The Federal Reserve. The Federal Reserve is raising interest rates. You raise interest rates, you slow down people buying things. That should bring down the demand for labor from 11 million down to 10 million, down to 9 million over the next few months. The labor supply is down here. Those unemployed workers, the red there, about 6 million. We're trying to get that back up, get back to 7 million, 8 million, get the labor supply up to get these 2 numbers equal. It should happen by the year 2024. Why is the labor supply so low today? You hear what's called the labor force. The labor force participation rate is low today. Why did some people leave the labor force in the last couple of years? Well, we had COVID. Because of COVID, some people with underlying health conditions said, you know what, I'm kind of worried about catching COVID. I might die. I'm going to leave the labor force and stay home. So about 2 million Americans did that. Now with vaccinations, those people are coming back to work slowly, which is good. That should help bring up the red line, or my left hand here, bring that back up. We also have childcare issues. Because of COVID, it really decimated the childcare industry. So it was really hard for parents to find affordable and reliable childcare. Now that industry is coming back. It's about 90% back to where it was. We're still down about 10%. 10% of them are still closed. But we need to get more childcare so mothers and fathers can return to the workforce. That'll help increase the labor supply. And then also, we had a lot of baby boomers retire early. Why did a lot of baby boomers retire early in the last couple of years? Yeah, they could afford to. They had really high stock prices. Think about last January. Stock prices at record high. Inflation was really low. So when they did their financial forecasting models and say, hey, can I retire now? Do I have enough money to last the next 30 years? Their financial advisor said, yeah, they get a huge stock price portfolio and inflation is low. But what's happened since? Stock prices down 20, 25%, inflation up 8, up to 8%. Now they do their financial forecasting model and say, hey, I might not have enough money. I might have to go back into the labor force and keep working for a few more years. That will also increase my red line to get it closer to the blue line to get the market back in balance. But right now, we have a huge imbalance like we've never seen before in the history of the country. Notice the red is normally above the blue. Today, the blue is above the red. Just to show you what's happening with like wage growth, look how wages are growing right now, 5.2% increase in wages. Normally, let me give you a nice rule of thumb economists like to use. If you want to have 2% inflation, the price of goods and services going up, have about 3% wage growth. Workers making 3%, goods and services costing 2% more, 3 and 2, that's kind of the rule of thumb. Right now, we're sitting at 5% wage growth over the last year. It's going to get even worse in the next few months as our workers demanding their cost of living adjustment higher than that. But here we're up at 5%, which is bringing up the red line, which is inflation. So you can see strong correlation between the price of goods and services and the price of labor. They move together. And here's just another chart looking at, it's called the Employment Cost Index. That's up to 5.7% year over year change. So even that green is shooting way up. Think of green as your increase in wages that we're paying. 5.7, almost 6% increase in compensation costs when it comes to the labor force. Moving on to our forecast then. Once again, similar chart we've seen before. Red bars are recession years, green bars are growth years. My 4.5% gold line, economists should always have gold lines on their chart. Notice this year, we're going to be below that. 3.6% unemployment are going to average this year. Next year, it's going to start moving up. As the economy slows, less job creation, the unemployment rate will slowly tick up to 4. And then once again, by the year 2024, remember that year, that's when the economy is going to be back into balance. We'll have the unemployment rate back at that 4.5% and forecasting it to stay there for the out years of 2025, 2026. So what are the takeaways from this chart? Number one, a labor shortage. We're going to have that for the next couple of years, next 2 years, where basically demand for labor is going to be greater than supply, meaning point number two, bargaining power has shifted towards employees. They can demand better working conditions, higher wages, work in remote or hybrid. They've got the bargaining power right now. Number three, increased labor turnover, churning, quits. You know, I work in the banking and credit union industry. I've talked to some banks and credit unions that say they had a 50% turnover rate in their frontline teller staff. Like you've all been to a bank, you got the tellers there, 50% turnover. Just think about how long it takes to train up somebody to be a teller. It takes weeks and months. All of a sudden they quit on you because of the churn here. So it's pushing on number four here. Labor wages are going up 5-6%, and training costs are also exploding. Bigger part of our budget, more dollars going into training these people that may quit on us at any time. Number five, lower labor productivity. When you get somebody new on the job who's only been there a few weeks, clearly they're not going to be as productive as somebody who's been in a job for many years. So productivity is way down. With that lower productivity comes what? Lower customer satisfaction. If you got somebody new on the job, they're not going to be able to do it as well as somebody else. So when you have customers come in, they're going to see that these people are not quite as well trained as some older people were that aren't working there anymore. And so basically your customer satisfaction surveys could be seeing lower numbers. We have record low bankruptcies because the labor market is so strong. A good thing is that very few people are filing for bankruptcy today, which is good. And then point number seven, it's going to take 2 years for that labor force participation rate to get back to where it was before. Let me just give you some numbers here. Before COVID, about 63% of the adult population was in the labor force, meaning either they were employed or they were unemployed, but they were willing and able to work. 63%, lock that number down. Because of COVID, remember I said people quit because of underlying health conditions and worries about COVID. Some couldn't find childcare, some baby boomers retired earlier. It went from 63 out of every 100 people working down to 61. So we lost 2 percentage points. Where are we today? We've climbed back up to about 62.3%. So you're from 63 down to 61, we're back up to 60. So we are climbing back up. Probably going to take another year or so to get back up to the full 63%, which we were prior to COVID. Now, let me ask you, what is the most important price in any economy? Is it the price of oil? Is it the price of gold? Is it the price of the dollar, the exchange rate? The answer is no, none of those. It's actually the price of money. And what is the price of money? Well, it's just interest rates. Basically, that's how the Federal Reserve controls the economy. They raise interest rates to cool the economy down. They lower interest rates to speed the economy up. Let's take a look at what the Federal Reserve could be doing over the next year or so with respect to interest rates. Let me put it up on the chart. Here it is, this gray area. This is the most important interest rate in the world. This is the Fed funds interest rate. Now, what is that? You may say, what's the Fed funds rate? That's the interest rate that banks lend money to each other overnight. You got Bank A lending money to Bank B overnight. It is not borrowing from the Federal Reserve. It's kind of a misnomer to call this the Fed funds rate because it kind of sounds like the bank is borrowing money from the Federal Reserve, which they're not. They're just borrowing from each other, but the Federal Reserve controls this interest rate. Notice how smooth that the chart is. That's because it's controlled by the Federal Open Market Committee, the Federal Reserve in Washington, D.C. Like I said, every 6 weeks they meet. Notice where we're at today. Notice first of all, my gold line. That's what we call the neutral rate. When the Fed funds rate is at 2.5, the Federal Reserve is not messing around with the economy. They're not having interest rates too low to stimulate it, high to restrain it. Where are we today? Does anybody know where's the Fed funds rate at today? Notice where it was just back in 2020. Notice right here, the Fed funds rate was pretty close to zero. Let me throw another analogy out at you. Think of the economy as a car. You want your car to go faster, what do? You step on the accelerator, right? Pushing interest rates to zero, that's the Fed having the accelerator to the floorboard. They're giving it all they got to get this economy going. Now the Fed's been easing off. They took their foot off the accelerator, put it on the floorboard. Just recently, they raised it to 3.1. So see that little mountain there? That's where we're at today, 3.1. That's where we're at. That's after the last Fed move. The Federal Reserve finally took the foot off the accelerator and started pressing on the brake. We are now pressing the brake to slow the economy down to bring inflation down. The big question economists are dealing with, well, how high are they going to go with this? When's the end point, what we call the terminal rate, the highest rate? Well, right now, best guess, about 4.6%. Rates are still going up. Like I said, by next Wednesday, if we're at 3.1 today, add 75 to that. We're going to be at what, 385 or so by next Wednesday when, if we met again. We're getting close to that 4.6. We're getting higher and higher. Then notice we expect the Fed to reverse policy, or what's called the Fed pivot, and then start to bring rates down once inflation reaches that 2.5%. So let me put up a little purple box so we can be clear on this. The Fed to raise interest rates above 4% by the end of this year. They were at zero at the beginning of this year. That is a 4 percentage point increase in rates in 1 year. I've been doing this economic stuff now for almost 40 years. I started in 1981, my first econ class back in college, and I've been doing it ever since. We've never seen interest rates go up 4 percentage points in 1 year. This is very fast. Short-term interest rates hit 4.6 by the end of 2023. And then the goal is to reach that neutral range, about 2.5, about there by the year 2025, 2026, when they bring it back down to the neutral territory. But interest rates are going up, which means the cost to borrow money from your bank and credit union are also going up for the next year or two. Now, the second most important interest rate. You see the blue line I have on the chart? That is the 10-year that's the 10-year Treasury interest rate. It's at the benchmark interest rate for most products, most type of credit out there. Specifically, the one that you and I might care about, notice the 30-year mortgage green line. 30-year mortgages interest rates at the beginning of this year were 3%. You can see it right there in my chart. 3%, here's 2022. Look where the green line is, 3%. What's it today? 7. It's more than double. Notice, mortgage interest rates are higher today. My chart goes all the way back to 2007, the last housing market. Interest rates are higher today than they've been in over 14, 15 years. Very, very high interest rates to slow the economy down. The Fed wants this. The Fed wants interest rates to go up, which will slow the housing market. Housing market is the most interest rate sensitive sector of our economy. Notice the spread between the two. We call that a credit spread. When you lend money to the government by buying a treasury bond, you get the blue interest rate. It's lower than the mortgage rate. Why? Because is there any credit risk when you lend money to the government? Will the government always pay you back? Yeah. Why will the government always pay you back when you lend them money? They can do what? They can print up money, right? They can just print up more money if they have to and pay you back if you buy a treasury bond. Humans like you and me, we can't do that. If we try to do that, what's it called? Counterfeiting. We go to prison for that. So basically, we have to add in about 1.75 credit spread, credit risk, because every once in a while, a human gets hit by a bus and they don't pay the bank back. So you got to add a little bit of interest for that risk. Notice where it's at today, 3.3%. We've really increased the spread because there's so much volatility right now in the mortgage market, so much uncertainty. We've increased that risk spread to almost double its current level. So now is a really bad time to get a mortgage because not only is the 10-year up, which is what the 30 years normally priced off of. Normally the rule of thumb, take the blue line and add 1.75 to it and you get the 30-year mortgage rate. But today, take the blue and add 3.3 because so much risk and uncertainty in the mortgage market today. What's our forecast then for this long-term interest rate? Which is key because it kind of affects long-term mortgages. So any of you think about buying a house or refinancing, we expect basically the 30 or the 10-year treasury to kind of remain where it's at. You know, the equilibrium, if you will, the balanced market is around 3.5%. Right now, it's a little over 4%. We think it's a short-term abnormally high rate. We believe it's going to stay about 3.5, which means mortgage rates are kind of going to stay where they're at today, probably around 6.5% for the next 30 years. We don't expect mortgage rates to go back up to 7, 8, 9%. We expect mortgage rates to stay around 6.5% for the next few years. How is this impacting the economy? How does what we call monetary policy, the Federal Reserve raising interest rates, how does that actually impact us? You see this chart here? This is a chart on housing starts. Think about here in Madison. You got some home builder going outside of Madison, buying up a bunch of farmland, digging holes, pouring concrete, putting up the studs, the walls, the windows, the roof. They're building homes. So this is a chart on housing starts. Now you should say, Steve, where's your gold line? Is it supposed to be a gold line on economic charts? Yeah, but let me use a green line this time just to mix it up. Basically, 1.2 million is the number of homes we should be building each year. Like this year in 2022, we should build 1.2 million homes. Why? That's basically growth in population. We call that household formation. Think about little Johnny moving out of mom and dad's basement. He needs to buy his own house or get his own apartment. We need about 1.2 million housing units each year. Notice how the chart doesn't always go with that. The demand is about 1.2 million, but notice sometimes we do a little overinvestment. A little trip down memory lane. Back in 2004, 2005, notice we were building what? These are in thousands, so that's 1.8 million homes we were building. Way too many homes. 1.8 million. Well, when you have a period of overinvestment where you're building above the green line, we built too many homes in this country, it's followed by a period of underinvestment. So we went from a boom to a bust. That's when we had those banks fail. Remember Lehman Brothers failing, AIG, the biggest insurance company in the world, they failed. Hundreds of banks failed in this country during this time period. Then notice for the last 12 years how the yellow, which is housing starts, the new supply, has been less than the green, the demand. So for the last 12 years, we haven't been building enough homes in this country. We have a legitimate housing shortage today. We haven't been building enough because the yellow has been below the green. For some reason, we just haven't been building enough homes. Notice what's happened recently. See that blue line and the yellow has dropped about 20%. Remember I said housing is the most interest rate sensitive sector of the economy? There it is. The Federal Reserve has already raised rates and housing starts are already plummeting. Very sensitive to what the Fed does. So the Fed's slowing the economy down. Like I said, a lot of electricians, plumbers will leave that industry, not be laid off, but just go into infrastructure building, roads, bridges, highways, schools, things like that. But it is already impacting the economy, monetary policy. What about existing homes? Now that was just new homes, right? Building a new home, but most of the housing market is existing homes. That's you buying my house, I'm buying your house here in Madison or Middleton, Sun Prairie, wherever you live. The existing housing market is way bigger. Notice my gold line, 5 million. That's where we should be. Notice where we were prior to our current situation. Notice I got a little red line there. There's your COVID recession in 2020. But notice how housing was doing. That green was way above the gold line. Why? Why were we selling so many homes the last couple of years? The green was up to what? 6.5 million, reading off the left axis there. Very high. Everybody's buying homes. Why? Record low interest rates. We had record low interest rates in this country. Everybody wanted to buy a home. So it had to do with the price of money, interest rates, the Federal Reserve, thank you very much. But it also had to deal with what? Demographics. Think of the millennial generation. Who are the millennials? People between 26 and 40 years old. What are you doing when you're 26 to 40? Getting married, having kids, buying homes. There's 83 million millennials out there. 83 million. They are the biggest demographic group in the country. Bigger than the baby boomers. Now, I'm one of the youngest baby boomers. If you're born between 1946 and 1964, you're a baby boomer. I was born in 1963, so I have a younger brother who was born in 64. So him and I are some of the youngest baby boomers. Think of the oldest baby boomer is Donald Trump. So between anybody between Trump and me, we're the baby boom generation. But we used to be the biggest, but not anymore. Why? We're dying out. We're getting old. There's a few of us, we die. But the millennials are now the biggest. There's a whole bunch of them still buying homes. Remember, the gold line is 5 million. The Fed's raised rates since March of this year. Notice where we're at today. My little green box there, we're at 4 million. So the Fed kind of got us all the way down to 4.85 million. Hey, that's close enough for government work. Basically, we're right at where we should be on this market. We've slowed down. It hasn't gone, it's probably going to go below that. But right now, we're kind of right at the gold line, pretty close. But notice the blue line. The big story in housing has to do with inventories again. You see the blue line I just added? If you read off the right-hand axis, we got about 1.3 million homes for sale. I mean, think about that. Visualize that. You got 1.3 million homes today with a for sale sign jammed into the front yard. 1.3 million. Is that high or low? Well, look at the chart. We should have double that. Should be around 2-3 million homes for sale. Notice how the blue line keeps dropping over time. That isn't supposed to happen. We have more people in this country every year. We have more homes in this country every year. So you think there'd be more homes for sale at any time. But for the last 12 years, it keeps getting lower and lower and lower. Nobody is moving. The mobility in this country is dropping. Nobody wants to sell their home. Also, the baby boomers, which is the second biggest demographic group, they've kind of downsized into the house they're going to die in. So they're not switching homes. There's just very few homes for sale. So let's put it all together. You got very limited supply, only 1.3 million homes, and we should have like 2.6 or 3 million. So not much out there to buy, but you still got a lot of millennials who still buy a house even at 7% mortgage rates. A lot of demand with little supply. What does that do to price? Price is up 19% in the last year. Just think the house that you live in, if you live in the average home in America, is almost 20% more valuable today than it was a year ago. Let's take a look at the chart on that. Here it is. Here's what's called the OFEO house price chart. Just looking at home prices, year over year growth, second quarter this year, say second quarter last year, up what, 18.7%. Hey, let's round that to 19%. 18.7% increase. We talk about the housing bubble of 2005, 2006. Notice the housing bubble back there in my middle of my chart, 04, 05, I put 10.7. That was the biggest year over year increase. So prices hit 10.7. Notice they crashed 10%. There's a nice symmetry there. Economists are always looking for nice symmetry. Went up 10%, down 10%. There's the boom, the bust. Where's my gold line? About 4%. If you buy a home in the United States, expect it to go up about 4.1% each year. So if you have a child, say, hey, mom and dad, should I buy a home? Yeah, buy a home, it'll typically go up about 4.1% each year. But some years more, some years less, but on average, about 4.1. Let me ask you, we had the boom and bust back in 05 through 2009. There's the housing crash. But today, we're almost double that. 19% increase in home prices. What do you think? Are we going to see a crash in prices like we saw 20 years ago or 15 years ago? What do you think? Are we going to see another prices just come crashing down 20%? And notice how many years they stayed negative. Look at the years between 2007 and 2012. We had 5 years where my line was in the negative territory. 5 years where home prices kept falling year over year over year. What do you think? Are we going to see another crash? I'm going to use the four most dangerous words an economist can use. This time is different. We don't think prices are going to crash. Why? During 2005, remember, we had a surplus of homes. We had a period of overinvestment. We built way too many homes in this country. I remember watching the news. They were bulldozing brand new homes in California that got built and nobody wanted them. They bulldozed them down. Do we have that today? No. We have a shortage today because of 12 years of underinvesting in the housing market. So no, we aren't going to see prices go negative 18%. They're going to slow their appreciation, but not go negative. What's happening here in Wisconsin? I thought it'd be interesting just to compare Wisconsin to the national numbers. 15% increase in prices. Notice double the 7.4 back in 2005. But we had our own little boom and bust, not as big as the nation. Remember, the nation number is like 10%. We're 7 and -5. But we went through a good 4 or 5 years there of negative price appreciation. But this year we're up 15%. Wisconsin, 4.2, slightly higher than the national average for overall price increase. All right, so what's our forecast? Well, here's my forecast chart. US home prices, how much are they going to grow each year for the next few years? This year, we're still forecasting for 2022 there, 9%. Above my gold line. Remember, that gold line is 4%. That's what it should be growing at in a normal housing situation. 4%. It's going to be double, even with mortgage rates hitting 7%, because you have all these millennials out there trying to buy with very limited supply. Prices are going to go up 9%. Next year, though, 2023, probably only grow 4%. Still growing, not negative, because the demand is going to still be there. But then notice the out years of 2024 through 2026. Prices hopefully staying positive, but not hitting the gold line. Really slow growth in years in my wealth. You know, for a lot of us, our house is some of our biggest asset. Our house is not going to be growing as fast. So it means our wealth will not be growing as fast. In the last 3 years, if you and I own homes, we've seen a big increase in our wealth. We're not going to see that in those out years. Basically, we kind of pulled forward a lot of those price increases that would have took place in 2025, 2026, and we pulled them into the last couple of years. So we're not going to see this continuous increase in prices. So what are the takeaways in the housing market today? Here in Wisconsin, Madison, and around the country, a big market imbalance, basically. We've been underinvesting in our housing stock, we call it, since 2010. We have a lot better underwriting standards this time. So why did I say, hey, Steve, why are you saying we're not going to see a housing bust? Well, after the Great Recession of 2008, 2009, the government put in new rules and regulations on banks and credit unions. So once again, I'm the chairman of the board of UW Credit Union. We got new rules that when we make loans to you, we got to double check to make sure you can actually pay it back. So there are more strict underwriting standards when it comes to the mortgage market. So 3, no housing bust this time because of that. Number 4, slowing growth in household wealth. Remember in these out years when your home's only going up in value 1%, it means your wealth's only going to be growing a lot slower than it has in the last few years. And also just higher building materials cost, very tight labor market to build houses today. Let's move on to vehicles. Remember I started out talking about the Cadillac dealership only having, say, 25 cars and they normally have 100 cars for sale on their inventory. Take a look what's still happening with autos. Where's my gold line? Where should we be? We should be selling about 16.5 million cars each year in this country. That's to keep pace with population growth, income growth, things like that. 16.5 million. Plus you got all the old junker cars that need to be taken off the road and crushed in the little compactors. 16.5 is where we should be. You want to see what COVID did to the auto industry? You see that little white V there in the year 2020? There's COVID. Sales just crashed because government said, hey, you're not an essential business, you auto dealers, you got to be shut down. So auto sales plummeted, but notice how that blue mountain jumped right back to the gold line at the end of 2020. It wants to be there. And economics, like I said, it's kind of like the human body. Your body wants to be at 98.6. This blue wants to be hugging right around that gold line. But where are we today? Well, you can see the latest number. I got a little blue box there, 13.5 million. We're not at 16.5 million. The sales are still weak. Why? Well, because we don't have the inventory there. Plus, there's so much backlog of orders that they're trying to make these cars as fast as they can. So we're just not selling that many cars today. And basically, if you wanted to order a brand new car today, say you wanted to buy a brand new Cadillac. Say you want to get a brand new Escalade Cadillac built down there in Arlington, Texas. If you put in an order today, it would take you about a year to get your car. Normally it takes about 2 months. It takes 12 months today. So just the backlog of orders that they have, we're only selling about 13.5 million cars. Hopefully in the next year, that number will start going up, meaning jobs will be added, which will offset any slowdown in the rest of the economy, especially in the housing market. Moving on then, kind of wrapping up the overall economic update summary for next year, 2023. Number one, slow economic growth the next 2 years. Remember I said, if you want to use the word recession, call it a growth recession. My bars are not going to hit my gold line. We're going to be growing, hopefully, but not as fast as we should. Number two, falling inflation rate. This should be the worst of the inflation. It should be coming down to 4% next year from roughly 8% this year. And then landing, my soft landing, my airplane, on the 2.5% tarmac in the year 2024. Number three, unemployment rate below normal for the next 2 years, meaning a tight labor market, which means it's going to be difficult to recruit and retain workers at your place of employment. Number four, long-term interest rates rising to 3.5 over the next couple of years. Remember, that's the long-run equilibrium rate for the 10-year Treasury. 10-year Treasury is a benchmark for many other like mortgage products. Number five, home price growth slowing. As we saw, home price is going to grow 9% this year, but only about 1-2% in those out years. What about healthcare costs? As we're talking about healthcare industry, a couple bullet points here for you. Encourage preventive care for your employees in order to manage some of these costs. Medical care costs, as you saw, some of the fastest increase in overall costs in the economy right now, of course, are medical costs. Number two, consider providing direct primary care to minimize costs. Three, consider providing wellness clinics to encourage employees to monitor their health. Once again, ounce of prevention is worth a pound of cure here. Four, consider self-funding to pay for whatever care is actually used instead of providing insurance and greater costs and not maybe using all of it. Number five, consider benefit plan redesign. And then the last one, steering employers where care is good and costs are low to minimize our healthcare costs today, which are having a big impact on our overall bottom line, our net income, our profits. All right, with that, I'll open up for any comments, questions, snide remarks you may have. Yes, sir, I see a hand up. Yeah, he's talking about in the tech sector, they're already going through a big drop in their stock prices, mainly because of rising interest rates. Really hurts the tech sector because in tech sectors, most of them are kind of considered growth stocks. So most of their profits are out in the farther distance as compared to today. So whenever you push up interest rates and you do the present value analysis on their profits, it really hurts their stock prices, which is also hurting their overall performance. So they're getting more layoffs there. So we are seeing a little bit of supply, but still the tech sector relative to the entire economy, it's not having a movable effect on the overall numbers because we're not seeing that many people being unemployed to actually shift the major numbers to affect wage growth and things like that. It's just not large enough. Anything else?
Given the forecast of interest rates and all that, and you mentioned our wealth in our 401ks being devastated right now, what would be your forecast for stock market 401k rebound going into the next couple of years?
Right now, the consensus talking, from what I'm hearing, I'm not a stock market forecaster, I'm just an overall macroeconomist, but I would say we're going to see volatility at least through the first quarter of next year. We believe stock prices should start rising in the midpoint of next year as the economy is kind of less uncertainty taking place. Hopefully the war in the Ukraine will be kind of finishing up maybe by next spring. Negotiations come to wrap that up. Basically, we expect the stock market to rise in basically the first, second quarter of next year. But right now, there's just too much uncertainty in the world. You got China with their COVID lockdowns. You got their housing crisis taking place in China. There's slow growth. You got Europe has their recession. So until there's just too much uncertainty, that's why stock prices are so volatile. You see them dropping 2% one day and they come back 1 or 2% the next day. There's just way too much volatility because there's so much uncertainty in the world. But if I was a betting man, I'd say by next spring, we'll see the bottom and start to rise.
I'm curious about student debt relief, and if that happens, how it would impact the economy and inflation.
Well, if people get 10,000 or 20,000 of their student debt wiped out, that increases their balance sheet. We call that a wealth effect. People get wealthier in a sense. When you have less debt, you're typically wealthier from that. That will increase the spending power of those millions of people who get that relief. that will increase purchasing, which will actually make inflation worse or keep it from falling as fast. So it will cause inflationary pressures in the economy and keep the economy moving along. Because like I said, for two effects: one, I'm not writing checks anymore for my student loan or smaller checks, but two, on my balance sheet, I just feel wealthier because I have less debt. And so for those two effects, we'll keep the spending growing and prices are growing, and basically keep inflation higher than it otherwise would have been.
You have 1990 or so, we had in healthcare systems about 2.4 persons who were supporting each physician. And that number today appears to be something north of 10. One of the arguments that's been made in local healthcare sort of ecosystem or systems has been, we make more jobs, so we should have more healthcare. Can you talk to us about how does that work in the eyes of an economist?
Wow, I've never thought of that question before. I don't know if Cheryl would like to address that. I've never put much mental energy to that ratio. That's a very interesting ratio. You said 2 up to what, 10? Catch me at break. Give me a couple of minutes to think about it, because that's a good question, but it's a little for me to formulate a correct response up here, because I've never really dealt with that issue before.
Yeah, no.
Unless Cheryl would like to address it, since she's more of a healthcare person.
Tim, do you have some thoughts?
Well, I don't have, I'm looking for smart economists to help me with.
I said,
I
catch
don't
me
wanna
at break
put
when
my-
I'm drinking a Coke, and then we'll
put my
talk.
neck on the line. No, but we as employers, and I've been one, we don't necessarily, we want excellent transplants, right? We want excellent high-end care.
Yep.
You've made a recommendation for direct primary care where we actually don't need as much technology, right? We just need great relationships and people being able to, know how to take care of their diabetes and their cholesterol and their hypertension and such.
Yep.
At least when I was a business, it was hard to watch the growth of healthcare capital investment at a time when I didn't have enough primary care, or I couldn't believe necessarily that more healthcare would necessarily ease my local economy's strains. Does that make sense to the economist?
I mean, that does make sense. But I don't know if I can add more than what you're already thinking about, because you've thought about this a lot more than I have. I'm just the macroeconomist. That's a specific healthcare issue.
That's great. We'll talk that microeconomics over the break then.
Yeah. All right.
Hey,
we'll
thank
do that.
you.
Well, thank you for your time.
Steve, thank you so much.